Hello, this is Julius from Basic Financials. Today you're going to do a video about selling your residential property. Now, this might be your own property, or it might be a property you've been renting out, or it might have been both at some point. So first of all, if you sell your residential property and it's been your residential property all the time, there's no tax to pay on that. You get something called private residence relief. So keep that in mind. If it's been your private residence for the whole time you've been in it, then no capital gains tax to pay when you sell the property if you make a gain. Now, if you've got a rental property, so you've been living in your own property and you've decided to invest in another one somewhere and rented it out, that is subject to capital gains. Now, the way that works is you look at the cost when you bought it, any improvements that have been made to if you think about improvements, I mean, there are obviously two different types. You could be doing decorating and repairing things that have gone wrong. That would go against rental income. But if you've got, for example, you build an extension or anything that you haven't set off against your rental income, basically, then that might something that might improve the value or increase the value of the property, for example, then that could be regarded as a cost to set off against any capital gain. So you've got your cost when you bought it, plus all the solicitors' fees and stamp duty, and then you look at the amount you've sold it for, take off solicitors' fees and estate agents' fees, and also take off any improvement costs during the period you've had it, and that is your gain. And then your gain, if it's a residential property, it'll be it's taxed at 18% if you're a basic rate taxpayer, or it's taxed at 28% if you're a higher rate taxpayer. And if it takes you into the higher rate, then you pay only at the bit that it's taken you into at 28%. Now, so that's the basics of capital gains on selling a residential let property. There's one fairly straightforward way that you could mitigate on the tax that's paid, the capital gains tax that's payable. At this point, I should say, in that gain that you've just made, if you have made a gain, you do get a capital gains tax annual allowance that you can set off against that gain for a while, and for a while going forward it's 12,300. It's an allowance that changes, normally it changes each year, but it's been frozen for a while, and it's an allowance that if you don't use it, you can't carry it forward. It's a bit like your personal tax allowance, and it's only for that year. But if you're married or in a civil partnership, then you could transfer part of the property to your spouse, and you both get that annual capital gains tax allowance. So if you know you're going to be selling a rental property and there's a gain on it, and the gain's going to be more than your £12,300 personal tax allowance, capital gains tax allowance, then you could transfer half of the property. You could put it in joint names and then sell it, and then you've got two lots of 12,300. Another thing to think about there is also, if one of you is a higher rate taxpayer and the other one is a basic rate taxpayer, you could reduce the tax rates by doing that as well. So if you're a higher rate taxpayer and your spouse is a basic rate taxpayer, then that would reduce the rate. The other thing to bear in mind is you could obviously have lived in that property for some time as your home. Might have been the first property you bought, and then you decided to buy another one to live in, and rather than sell the old one, you decide to rent it out. Now, that's, you could see there, you're potentially losing your principal private residence, but you're private residence relief, but you're not going to, not entirely anyway, because you can apportion the gain between the period that you had it as your home and the period that you were renting it out. And the period that the portion of the gain related to when you had it as your house, then that's exempt from capital gains tax. When I say the portion that while it doesn't matter what happened to the value in that time. You look at the change in the value over the whole period, and then you just apportion between the length of time it's been your home and the length of time it's not been your home, and the length of time that it's not been your home is the time that is subject to capital gains tax. Now, another important thing to bear in mind is that the last 3 years, it used to be, now I think it's only 9 months, but the last 9 months, so to say that now, is ownership is always regarded as your private residence, so it would be exempt for that period at least, and remember to add that to your period of ownership as a home. Yeah, so I think that is probably enough. There's quite a lot on HMRC website and other websites about this topic, and have a research around there, but there's some of the things to watch out for. Hope that helps. If you could like and subscribe as usual, and leave any comments in the box below, then I'll see you again for another video soon. Thanks for listening.